This is Nightly Business Report with Bill Griffith and Sue Herrera.
Tricks and treats. Stocks surged the final 2 days of the month, but October was still one of the worst for stocks in recent memory. So where do we go from here? Opportunity knocks. Did October's free fall create bargains for investors? We'll take a look at some possibilities. And room service, an exclusive look inside the country's most expensive hotel room with a jaw-dropping price tag. Those stories and much more for this Halloween edition of Nightly Business Report, Wednesday, October the 31st. And we do bid you good evening, everybody, and welcome. Sue has the night off. Halloween. By most accounts, its origins trace to an ancient Celtic festival when people would dress up to ward off spirits. Well, fast forward more than 2,000 years, and you may find investors hoping to ward off the ghosts of this October and put it to rest, because this month was not for the faint of heart. Today, stocks did rally strongly for a second straight day. The Dow rose 241 points, back above 25,000. The Nasdaq climbed 2% or 144 points, and the S&P 500 added 29. And while the Dow added nearly 700 points over the past two trading sessions, it softened the blow of one of the worst months we've seen recently. In fact, now might be a good time to cover your eyes, because for all of the month of October, the Dow fell by 5%, its worst month since January of 2016. The S&P 500 was off just about 7%, its biggest one-month slide since September of 2011. And the Nasdaq really took it on the chin, down more than 9%, its worst showing in a decade. All in all, the U.S. stock market lost around $2 trillion of value this month. Even oil prices were not spared. They were down nearly 11%, the worst monthly loss we've seen in 2 years. And as Bob Pisani tells us now, many on the street just want the calendar to change.
After the roller coaster stock market we saw in October, many traders are crying out, just get us into November. And good news, there's plenty of reason to believe that November will be a better month than October. We've already witnessed dramatically oversold conditions in the market, and already there's been a turnaround. Many sectors, particularly semiconductors, home builders, metals, energy stocks, way oversold. And given the huge sell-off in October, pension funds will likely rebalance and pour more money back into stocks in November. Buybacks should also give the markets a boost. November is typically the most active month for buybacks, and activity will likely pick up as CFOs seek to use the large cash hoard still on hand to buy their stock back at lower prices. Finally, seasonal flow should be greatly improved. The S&P 500 has been higher from the October lows until the end of the year every single time during a midterm election year going back to World War II. That's a good number. Then there are the hopeful outcomes. Even a modest decline in volatility, get that VIX down below 20, that'll dramatically lower concerns. On any hint of progress also on trade will lift China stocks and global sentiment. But some of the skeptics are asking if any of this will keep 2019 earnings expectations, which are still high at 10%, from being knocked down to, say, 0 or 5% growth. Because that's what the market seems to be implying. That's something we still have to figure out. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Strong earnings before the bell from General Motors set the tone for this day. The automaker posted much stronger earnings than expected. In fact, GM's third quarter profit was 62 cents better than the estimates on Wall Street. Shares rose 9% on the day. Phil LeBeau tells us now what drove the company's huge quarter.
General Motors' latest earnings are a testament to the automaker's strength in its two biggest markets, the U.S. and China. In both countries, profits are surging. Take the U.S., where GM's new full-size pickups are helping it earn more money per vehicle because customers are paying higher prices.
GM's product cycle is really well timed now. They've got the launch cost of the full-size, new generation full-size pickup truck done. That truck just launched in August. And then you can use that same platform for the highly lucrative full-size SUVs like a Cadillac Escalade, Chevy Tahoe. So there's, for now at least, there's quite a bit of pricing power.
In China, where GM has been pushing the Cadillac brand, the company earned nearly $500 million.
We've had record Cadillac sales in China, and we're up 20% year over year. And as in an overall strong luxury market, Cadillac is doing exceptionally well as well.
While GM profits are rolling right now, it still faces plenty of issues. Higher interest rates will drive up monthly payments for auto loans. Commodity prices for steel and aluminum are rising due to tariffs. And what happens if America's appetite for new cars and trucks cools off? All of that is why CEO Mary Barra says GM needs to remain as lean as possible, which is why the company is offering buyouts to about 18,000 salaried workers. If enough employees take the deal, GM says it will not have to resort to layoffs. Phil LeBeau, Nightly Business Report, Chicago.
One company that Wall Street will be laser focused on when it reports after the bell tomorrow is Apple. The tech giant has held up better than its peers this month, down a mere 3%. So what should investors expect? Josh Lipton takes a look.
A key question for Apple is what initial demand looks like for its latest and greatest smartphones, the iPhone XS and XS Max. Bulls have high hopes that these two new devices will be big hits with consumers, driving revenue and average selling prices higher. Investors will also make a beeline for the company's revenue guidance.
The revenue guidance is important for the December quarter because it'll tell us the level of confidence that Apple has in the XS and XS Max, which shipped at the very end of September. The other thing it'll do is provide us an indication for how the XR is performing after it launched on October 26th. We think that's very important given we expect the XR to be the #1 selling iPhone this coming year.
Beyond Apple's hardware, investors are also very focused on its faster-growing, higher-margin services business, which includes its App Store. Wall Street thinks that business grew 20% to more than $10 billion in the quarter. And given increasing trade tensions, mainland China will be a hot topic. Apple is in 5th place in the smartphone market in that country. On Apple's last conference call, CEO Tim Cook said that the company's products had not been impacted by tariffs imposed by the Trump administration. But are there subtler impacts? Has Cook seen any kind of negative impact on consumer sentiment in China towards his company because of these escalating trade tensions? Investors should have a better idea tomorrow. For Nightly Business Report, I'm Josh Lipton, San Francisco.
Another strong reading on the labor market. Private payroll company ADP this morning said that 227,000 new jobs were created in the private sector in October. That far outpaced the 189,000 positions that were expected by most economists. The bulk of the gains came from the services industry, followed by construction and manufacturing. In addition, September's payroll count was revised downward to 218,000 from the previous report of 230,000. One of the big things the market has been concerned with is slowing global growth, and at the heart of that is, naturally, China. One of the big numbers out today was a reading on that country's manufacturing sector. And as Eunice Yoon tells us now, the data will not exactly calm the fears of China slowing down.
October is the first full month after the U.S. and China imposed their latest round of tariffs, and the official data showed that factory growth is at its weakest pace in 2 years, slipping to 50.2 from 50.8 in September, just a hair short of a contraction. A number lower than 50 indicates a contraction. New export orders, which give us a sense of future business, contracted at their fastest pace in a year. The sub-index dropped to 46.9 from 48. Factories are getting hit by slowing domestic demand and deteriorating trade ties with the U.S. Reflecting the stress in the economy, the central bank set the yuan at its lowest level in a decade, sparking more debate here if the policymakers will allow the yuan to weaken past the psychologically important 7 mark. The stock market held up, but shares of top pork producer WH Group slid in Hong Kong. The company's shares in Hong Kong down 40% since Beijing first threatened to slap on the tariffs. The owner of Smithfields in the U.S. says earnings in the third quarter fell by 31% from a year ago because of high supplies and China's retaliatory 25% tariff on U.S. pork products. The average price of pork in the U.S. dropped by 12%. The news is adding to growing concerns about the economy here, with more analysts expecting Beijing to ramp up measures to stabilize growth in the coming months. For Nightly Business Report, I'm Eunice Yoon in Beijing.
So as we head into a new month, let's turn to a bull and a bear for their opposing views on this market right now. Our bull is David Lefkowitz. He's a senior equity strategist at UBS Wealth Management. And our bear is Barry James, the president of James Investment Research. Good to see you both. Thanks for joining us tonight. Barry, I'm going to start with you. You feel like the kind of action we saw in October is a hallmark of topping action in this market, right?
We do. Although I will say that there was a good buying opportunity last week, which we tried to take advantage of to some extent for our clients. But one of the things that we see as we look at the market, why we think we're in a topping phase, number one, valuations. At a bear market bottom, PEs are less than 10, price to books less than 1, and dividend yields over 6. We're nowhere close to that. The other thing that we have, of course, is now quantitative tightening, not easing. Right. Easing was responsible for a lot of the market run up, and we don't have that. Lastly, there's a mania going on through September. Companies with no earnings, losing money, were up 27%, while those with earnings were only up 8%. And that's been kind of a theme that we've seen for a while. Just a few stocks running, right. And that's made things very difficult. And then just lastly, when we look at the markets today, we've had $1 trillion of buybacks, and we've had spectacular earnings. The market's gone nowhere. And next year, we're not going to have either of those. What would that mean for the future of the market?
David, there's quite a laundry list there of concerns that Barry has. Why are you still bullish at this point?
Yeah, I mean, I think what we've seen in this sell-off is just a bit of an overreaction. I mean, for sure, there are a couple of cracks in the facade. The trade tensions between the U.S. and China are ramping up. You do have pockets of softness. We just heard about what's happening in China. And the market is contending with higher interest rates. But that being said, I still think the global expansion remains solidly on track. You've got China ramping up its stimulus. We think that's going to gain some traction in the months ahead. And the tariffs, while a headwind, are not going to derail the global expansion or the U.S. expansion. So I think we're in a transition period, but I still think we're going to see continued economic and corporate profit growth.
And having said that, though, David, we have noticed this summer a transition, to use your term, away from growth stocks to more defensive issues in this market. And they seem to have been leading the market higher. Have you done the same thing?
Yeah, we have noticed that transition as well. And at this point, we think value stocks look more interesting. I think we're going through a bit of a growth scare right now. And as we come out of this growth scare, it's going to be the economically sensitive parts of the stock market that I think are going to lead us out of this. And that tends to be the value stocks. On top of that, value stocks look very cheap relative to growth stocks. And that's another support for, I think, a nice outperformance in the months ahead.
Barry, I assume you're not 100% in cash. You said you found some bargains last week. Where do you go to invest right now when you're not that high on the whole market?
Well, in the shorter run, as David was saying, it's an upward market. We have a lot of momentum and a good economy. So I agree that probably areas, the cyclical areas, maybe the energy areas that have gotten beaten up here pretty much lately would offer some opportunities. But I agree wholeheartedly about the value side. Completely ignored. Nobody wants it, and that's generally the best time to buy something.
Technology had been a huge leader, and I want to ask both of you before we go here, FANG stocks especially. Barry, they started to show some wear and tear the last couple of months here. Do you like them as bargains, or you wouldn't touch them? What do you say about them?
Well, there's some that I like Apple. The others I'm not too interested in. I had a client earlier this year, sold our conservative fund, bought one stock, Amazon, and said, it's because it only goes up. And we know that that's not always true. So we think that they're cutting some dangerous ground right now, and we would prefer to move back into the other types of stocks, maybe even an IBM or Intel for that matter, as opposed to the FANG stocks.
All right, David, what about you on FANG stocks?
We have a similar position. We're neutral on technology and communication services, and that's the sectors where most of the FANG stocks reside. That being said, I think what's most important is maybe distinguishing a little bit between these different stocks. And some of them are looking actually pretty interesting and pretty attractive at this point. But overall, our preferred sectors now are energy and financials, and tech we're neutral on tech, not one of our preferred sectors.
All right, gentlemen, good to see you both. Thank you for joining us. David Lefkowitz with UBS Wealth Management and Barry James with James Investment Research. Coming up, where to find opportunity after the worst month in nearly a decade, and then Jane Wells trash talking.
I'm in Anaheim, California, where these folks are busy pulling stuff out that has no business being in the recycle bin. Like this, who knew? The recycling business model is broken. How to fix it? We talk trash coming up.
So as we close the books on what was one of the worst Octobers in nearly a decade for the market, our next guest says this month's global sell-off may have yielded some mouth-watering opportunities for investors. Joining us tonight, David Dietz, the president of Point View Wealth Management. Welcome back, David.
Thank you, Bill.
I know you're one of the great contrarians out there, so when most people are bullish, you are not. But now that we've had this bad month, you're starting to look for some opportunities here, aren't you?
Yeah, absolutely. It's been a brutal month with both bonds and stocks going down. But when you start looking at the whole investment landscape, really, that's the time to roll up your sleeves and start looking for some bargains. We're old-fashioned. We like to pay the least for each dollar of earnings and dollar of sales. We like to get the best dividend yield. And, you know, there are some great swaths of opportunity out there.
Well, let's put it in terms of some exchange-traded funds, some ETFs that you like here that have had a tough time. Vanguard's Total International Stock ETF has had a tough year, but you're starting to sniff around on this one.
Absolutely. You know, I love it how people say, I just want to index. But, you know, it all depended this year as to where you index. If you index overseas from its January high, you are now down 20% in the low-cost Vanguard International Index. But when you start, unpacking what do you have, a 1.8% dividend, domestic stocks, 3% over there. 1/3 less in terms of price to earnings, price to sales. So I'm thinking to myself, getting more income, same growth, a lot less for the financial metrics. Go for it.
Same thing here with the Vanguard FTSE Emerging Market ETF. Emerging markets have suffered greatly. You're looking at them.
Yeah, absolutely. And I mean, here, of course, people always say, well, don't forget about growth. But when it comes to growth, the emerging markets are growing about 1/3 to 50% faster than here. There you get an even greater dividend yield. 3.2 versus 1.8 and almost 60% more growth. What am I missing, Bill?
And finally here, as far as ETFs go, iShares has an S&P 500 value ETF and a growth ETF. Which I'm guessing you're going to go for the value at this point.
It seems like I'm echoing your former guest there. But, year to date, the value is down about 6 or 7% while the growth is up. And so, I'm using that as a way to just continue to go into the value areas. Remember, over the last 100 years, value stocks have outperformed. Now we're in about a decade stretch where values underperform. People say, well, how long can you hang into the value stocks? Well, if it's been down for a decade, perhaps you have a decade of outperformance coming.
Very quickly, a lot of our viewers like dividend-paying stocks for income and so forth, but in a rising interest rate period, it's tough to buy some of those dividend-paying stocks.
Well, it is, but the only thing worse than a good dividend-paying stock is a stock with no income being paid out, because that's going to be even less competitive to higher bond yields. The two we would recommend, Exxon and Caterpillar, as your quintessential value stocks that dominate their markets with dividends 3% for Caterpillar, over 4% for Exxon.
Very good. David Dietz, always love talking to you. Thanks for joining us tonight.
Thank you.
David with Point View Wealth Management joining us here. Elsewhere, Kellogg cut its full-year forecast, and that's where we begin tonight's market focus after reporting a quarterly sales miss caused by weakness in several of its U.S. businesses. The snacking giant tempered Wall Street's expectations with a revised profit outlook for 2018. Kellogg said that the new guidance reflected increased spending on advertising, a strategy that it says will lead to better revenue growth. Shares plunged, though, today by 9% almost to $65.48. Yum Brands said that its new menu items like $1 nacho fries and pickle fried chicken drew more customers into its KFC and Taco Bell chains, helping overall earnings top expectations. The company also said that those two restaurants experienced strong performance overseas. Yum Brands finished up more than 4% today to $90.41. Estee Lauder said stronger demand for its La Mer skincare and MAC makeup helped sales rise, and top estimates. The cosmetics company, which also reported a rise in profits, said that emerging markets and the Asia region saw robust growth. Shares rose more than 4% today to $137.44. And after the bell tonight, wearable device maker Fitbit reported a surprise profit and stronger than expected sales as it sold more products. The company also said it expects results for the current period to surpass analyst estimates. So shares initially rose in the after hours, and they also finished the regular session up 7% to $4.73. Waste management company Republic Services said that it has seen its stock rise nearly 65% over the last 3 years, crediting its success to its trash services. But recycling has been weak. In fact, so weak, the Republic says the country's whole recycling model needs to be scrapped. Jane Wells explains from Anaheim, California for us tonight.
The recycling business is getting trashed.
Well, the recycling model right now in the U.S. is broken.
Don Slager is CEO of Republic Services, a waste management company that's doing very well with its regular garbage business, not so well with recycling. And they're not alone. For years, the garbage man has collected our recyclables curbside, often at a loss, because he made good money reselling a lot of the material overseas, especially to China. But now China has an air pollution problem, so it has stopped buying things like our old cardboard boxes. And the value of those commodities have plummeted from about $200 a ton to half that. At the same time, the values of these commodities are coming down. More and more consumers are putting the wrong stuff in the recycle bin. These people are busy pulling out the bad stuff, the stuff that shouldn't be in there. For example, plastic bottles are fine. Plastic bags, no, they gum up the machines. And get this, while clean cardboard is great, if you put in the greasy part of your pizza box, you could contaminate the entire load.
Contamination levels are as much as 30%. So we're sending a separate truck to your home to collect what should be clean recyclables, and we're having to then spend a lot of additional time, effort, and money, frankly, cost, in cleaning that material up.
Republic Services has invested in technology to improve sorting, but it warns that if the resale value stays low, collection rates at the curb will rise, though they might rise more slowly if people learn what goes in the blue bin and what doesn't. Think loose paper, clean cans and bottles, because the company says here's the ugly truth. For all of our good intentions, nearly a third of what comes in here these days ends up in the landfill anyhow. For Nightly Business Report, Jane Wells, Anaheim, California.
Coming up, the most expensive hotel room in the country, and wait till you see the bill. Finally tonight, it is the priciest hotel room in America, and you will not believe what you get for the price. Our Robert Frank got the first ever on-camera tour.
Straight through the Mark Hotel lobby and up 16 floors is the most expensive hotel room in America.
Welcome to the Mark Penthouse.
Wish I had brought my bag. General Manager Olivier Lardenois is giving the first ever on-camera tour of the $75,000 a night hotel suite.
How big is this whole suite? 10,000 square feet. It is the biggest in the city.
The hotel room's interiors are by French designer Jacques Grange, whose portfolio of clients includes royalty and some of the biggest names in fashion.
So this is the main living room of the penthouse. The ceiling height is 26 feet.
There are 5 bedrooms, including not one, but 2 master suites. And heads up in the master bath, where water flows right out of the ceiling.
Let me show you the best views of the house upstairs.
One flight up past a sunlit lounge area is a 2,500 square foot wraparound terrace.
This is a great roof for a big party.
It is the perfect roof for an amazing party.
And the views here, I mean, you get Midtown, you get Central Park.
There's nothing like it in New York.
So what's included in this hotel room?
Absolutely nothing, except this wonderful space.
$75,000 a night, I would assume that includes breakfast.
If you're a potential client, that's not a question that we would ask. If you ask for it, I'd be happy to include it.
The truth is, penthouse guests blow past $75,000 per night and spend even more money on the hotel's over-the-top perks.
We have an agreement with Bergdorf Goodman that allows you to basically get something at any time of the night and day. We can take you to our sailboat downtown and have you sail along the Hudson River for a few hours.
What if I really like hot dogs?
There's actually a hot dog stand outside the hotel that's selling the most amazing hot dogs created by Jean-Georges, our chef.
That's right. The hotel's chef, who has a 2-star Michelin restaurant, also runs a hot dog cart.
What's the longest stay that you've ever had here?
16 months.
16, you said months?
Months.
Not days.
Months. You heard me.
That's a big hotel bill.
It is, but obviously they could afford it.
For Nightly Business Report, Robert Frank, New York.
Must be nice. Before we go, let's take a final look at the day on Wall Street. A few more people were able to afford that hotel room, with the Dow up 241 points today. We're at 25,115. The NASDAQ climbed 2%, and the S&P added 29. But the indexes all had their worst monthly declines in several years, and the NASDAQ's 9% decline was its biggest in a decade. That is Nightly Business Report for tonight. I'm Bill Griffith. Thanks so much for watching. Have a great evening. We'll see you tomorrow.